Palantir is scheduled to report quarterly financial results on Monday, February 3rd, 2025. That has investors asking if they should buy Palantir stock before the company announces earnings, after the company announces earnings, or whether they should buy Palantir stock at all. I'll answer those questions in this video here. I'll also preview what investors should look out for from Palantir when it releases its quarterly financial results, beyond the obvious things like revenue and earnings per share. It's a lot to cover in a short video, so let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
I'll start with the most powerful thing investors should look for from Palantir when it reports quarterly results, and that is its commercial business, revenue from enterprises, not governments, not government institutions, but enterprises, because this is where I feel Palantir's biggest opportunity lies. And its most recent quarter, U.S. commercial revenue jumped by 54% year over year and 13% from the previous quarter to $180 million. That compares to U.S. government revenue, which totaled $320 million. The commercial business is growing faster than the government business, and for Palantir stock investors, that's great news. Palantir has long demonstrated a great relationship with U.S. government institutions and institutions related to the U.S. government, allies of the U.S. government. But where Palantir has had more difficulties in expanding with enterprises. And it's not because Palantir is not a great business. It's because Palantir's services are so expensive, enterprises found it difficult to afford. But with the new program Palantir has implemented, they've unlocked a new source of enterprise revenue. And it's because they've demonstrated what they can deliver to enterprises. And so enterprises have found ways to increase their budget so that they can afford Palantir services. They cut back on other areas so that they can spend money on Palantir services. Or if they only had a budget, let's say, of $10 million for a certain category, they've expanded that category so that they can go out and afford Palantir services. That's been working incredibly well. And this is the area that has a lot of stock market investors, institutional, really smart investors, excited about Palantir stock because there are many more businesses in the world than there are government and government institutions. It raises the ceiling for Palantir's growth, and it makes the growth quicker because they can expand to more businesses more quickly. Whereas if they were strictly dealing with government institutions, there's a limit to that growth, and government institutions notoriously move more slowly in signing new deals, signing contracts, changing providers, changing policy, etc. So this has been an exciting thing for Palantir. I've been covering this trend for Palantir for a little over a year now, and I'm excited for Palantir stock investors for the success they've achieved in this category. Another great success story for Palantir in recent years, I would say the last 4 to 12 quarters, is their improvement in profitability. They've become profitable on the bottom line for several consecutive quarters now. In the most recent quarter, they delivered net income of $144 million. That represented a 20% margin. That's impressive for a company that spent roughly 2 decades of not being profitable. They've grown the business, they've adjusted, they've controlled cost as revenue has increased, and they've put themselves in this excellent position to be profitable on the bottom line. Additionally, the business generates great cash flow from operations, and cash flow from operations excludes stock-based compensation expense, which Palantir uses aggressively, but it's a non-cash expense. That's a share of the business going to its employees. If you exclude that, cash flow from operations of $420 million represented a 58% margin and $995 million on a trailing 12-month basis. A CFO to sales margin of 58% is among the best in the world of any size business, let alone a business the size of Palantir, which relatively speaking is not large. This is not a large business when you measure it on revenue, when you measure it on operating income, when you measure it on customer count, regardless of any measurement outside of market cap, which is growing to be large. If you look at all those other metrics, Palantir is not a very large business, but its cash flow from operations is already that of some better than some of the largest software tech companies in the world. And that's truly impressive. And that number is accelerating. It's not staying flat. While other businesses that have margins in this range, they've been relatively flat. So these characteristics, these foundational characteristics of Palantir stock is what's driving its valuation higher. It's one of those businesses where I've said that the stock price is increasing, but investors are also getting more. Now, I've argued that the stock price is increasing a little too quickly compared to its improvement in business because investors are very excited about what's happening at the company. And if it continues at this pace, then, looking ahead 2 years from now, 4 years from now, it could be a great value at current prices. The risk is paying such a high price for a business, assuming this incredible performance will continue. And it has been incredible performance, don't get me wrong. This business performance is truly astounding, and Palantir deserves credit. Management deserves credit for this phenomenal performance. I talked about the stock price increase, and over the last year, Palantir stock price has jumped from around $20 a share to around $72 a share. I had Palantir stock rated as a buy for, I would say, the first half of last year. And right around June or July, I can't remember precisely which date, I told Palantir stock investors that the valuation was getting a little bit too expensive based on the company's performance. Now, I would have delivered strong gains to investors for the first half of the year, but I missed out on those gains following that. But you could see here in recent months, the valuation has gotten to the company and the price improvements have kind of stopped. The momentum has decreased and the valuation, the price has come down a little bit. Still, when you look at the forward price to earnings, it's trading at a forward PE of 125, which is below some of those peak valuations of over 160, 175, but it's still very expensive based on the company's earnings per share growth expectations over the next few years and over the next decade or so. So to answer the question, should you buy Palantir stock ahead of earnings? Well, I would say no. I don't have Palantir stock rated as a buy. I do feel the business is an excellent business. It deserves a premium valuation. It's one of the best businesses in the world. All that being said, I think the price is still too expensive, even if you agree, like I do, like it's an excellent business, like it's going to continue growing, like the business opportunity is massive. I agree with all of that. I agree with all of that. But I think the valuation already incorporates that in there. So what I would say to investors looking to get into Palantir stock, not before earnings, I would say to put it on your watch list, digest the earnings results. Of course, I'll have coverage for you on those earnings and what it could mean for investors, and try to get into Palantir stock at a better price. And we'll know more what a better price is following these earnings results. Certainly, the current market price of around $70 a share, I feel, is too expensive. Maybe even $60 a share would be too expensive, all else being equal. So I would wait until after the earnings. I'm going to digest the results and give you updated information. If you look at my discounted cash flow valuation model for Palantir stock, the intrinsic value per share I've calculated is $18.50. The current market price is $71.77. Now, that was incorporating a beta of 1.5 for Palantir stock. If I did an analysis lowering the beta all the way down to 1, it would give me an intrinsic value per share of $31. So it's clear to me that under these situations, under these circumstances, with the current earnings per share and the current free cash flow expectations, Palantir stock, while it is an excellent business, is too expensive to make it a good value for long-term investors. So I'll have more for you after the earnings. I'll let you know if it makes sense after the earnings results. But as of right now, I'm saying it's not a buy. I'm saying it's rated as a hold, and it's too expensive for long-term investors.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.